Master the basics of option trading under 10 minutes. What is an option contract in trading terms? An option contract is a financial contract agreement. There are two sides to an option contract. There's the buyer and there's the seller. The seller is the one who writes the option contract. Elements of an option contract. Strike price. The strike price is the price at which the underlying security can be bought or sold per the option contract if you choose to exercise the option. Expiration date. This is the date on which the option contract expires. Premium. Premium is the price you pay to buy the option contract or receive the premium if you're the seller of the option contract. Option contracts can be a call option or a put option. Call options are defined as the right, but not the obligation to buy the underlying asset at a specified price, which is the strike price by a certain date known as the expiration date. Put options are defined as the right, but not the obligation to sell the underlying asset at a specified price, which is the strike price by a certain date known as the expiration date. There are many types of option strategies, but we are only going to focus on the basic standard options in this video since this is meant to be a beginner's tutorial. Calls a bullish trend, which means you believe the market is going in an upward trend. Puts a bearish trend, which means you believe the market is heading on a downward trend. In option trading, there's something called option moneyness. They are in the money, out of the money, at the money. Depending on if you hold calls or puts. Your moneyness is compared to the strike price versus the current stock price. When an option is at the money, it means that the option's strike price and the underlying asset's price are equal. When an option is in the money, it means that the option's strike price is more favorable than the underlying asset's price, which resulted in a profit. When an option is out of the money, it means there's no profit when comparing the option's strike price to the price of the underlying asset's price. There's something called intrinsic value in options. An option's intrinsic value is when there's profit existed comparing the strike price and the price of the underlying asset or stock. To understand options, you need to first determine if you're going to be a buyer of an option contract or the seller of an option contract. Many people find option confusing to understand because they only focus on calls and puts. But the important thing to understand is which side of the transaction you are, because buyer and seller of an option have different risk and reward profile. So which one are you? A buyer can buy calls or puts and pays a premium. Similarly, the seller can sell calls or puts and receives a premium. Sellers are the ones who write the contract. Think of it like a store. You have the owner of the store, which is the seller, and you have the buyers, which are the consumers. Calls and puts are just like the products in the store. Consumers can buy calls, think of it as oranges. Consumers can also buy puts, think of it as apples. Consumer pays money, which is premiums for the products, and on the other side of the transaction, you have seller, which is the store owner. The store can sell calls or puts and the owner received the money, which is the premium. Just like the products in the store, the stocks can go up or down depending on demand. Understanding how option prices known as the premium moves in an option contract is an important aspect of trading options. Depending on if you're the buyer or the seller and holding calls or puts. The price movement of a stock affects each differently. Here's a chart showing how the stock movement affects each of them. I encourage you to take a screenshot of this chart for your reference. Another important aspect of options trading is to understand your risk-reward profile depending on if you're the buyer or seller of the option contract. Buyers' loss is usually limited to the premiums they paid for the option contract. However, sellers have a higher risk profile. They can have unlimited loss, especially in the case of naked calls or unprotected calls, which means they sell option contracts on stocks they don't already own. I encourage you to learn more about it on your own since this is meant to be a beginner's video. In option trading, there are many factors that affect the option's price. They are called option Greeks. Option Greeks are financial measures that quantify the sensitivity of an option's price, also known as the premium. There are 5 options Greeks. They are as follows. Delta, which measures the change in option price relative to the change in the price of the underlying asset. Gamma, which measures the change in delta for a 1-point change in the underlying asset price. Vega, which measures the impact of changes in implied volatility on option price. Theta, which measures the impact of time decay on option price. Rho, which measures the impact of changes in interest rates on option price. I encourage you to learn more about these option Greeks in details and in order to have a better understanding of how each affects the option contract price. One of the most notable differences between buying the stock versus buying stock option is something known as time decay. With option contracts, each day this contract loses value known as time decay. Each day, the value of the option contract is reduced by the amount of theta value regardless of price action. Also, the decay accelerates as the option is closer to expiration date. So, in order to make money, the price movement has to be more than the daily decay amount. Let's take a look at a call option example. On August 29, 2025, you decided to buy an Apple call option contract at the strike price of $235 with the expiration date expiring on September 12, 2025, and pay a premium of $3.23, which amounts to $323 because each contract is equal to 100 shares. With any option contracts, you can take any of the three actions listed below. Number 1, you can choose to close the option any time before the expiration date. Number 2, you can let the option expire at expiration. Number 3, you can exercise the option contract. Let's take a look at each action. For example, you choose action number 1 to close the option before the expiration date. On September 3, 2025, Apple is trading above your strike price, and the premium has increased to $4.90, which you now have a profit of $167. Gain equals $490 minus $323. You could hold on to the option for a little longer. However, you decided to lock in the profit. So, you choose to close prior to the expiration date. Another reason one might choose to close an option early is to cut the loss if your trade goes against you. For example, Apple is heading toward a downward trend and is trading below your strike price. To avoid losing all your premium, you chose to close early to cut your losses. To close an option contract, you would do the opposite of when you bought the contract. On your brokerage account, you will see a +1 on the expiration date with the strike price you picked. This time instead of buy, you chose sell. That's how you close the option. I would say 90% of the time, traders chose to close the option before expiration date. Here is a visual example of what a call option contract looks like in your brokerage account. Whenever you buy or sell an option contract, you will see a +1 which represents one contract next to the strike price that you picked. Let's take a look at action number 2 where you let the option expire at expiration. Most people chose to close the option contract before the expiration date. However, you can let the option expire at expiration date and do nothing. In most cases, the reason for this choice is because the option is so out of money that it's worthless to do anything with it. So, you just let it expire on its own, which the brokerage will close it at the end of the day for you. Let's look at action number 3 where you choose to exercise the option contract. Remember, when you buy a call option, you have the right but not the obligation to purchase the stock at the strike price you picked. For example, on September 10, Apple is trading at $246, but you can buy it for $235. You will need to have 235 times 100 equals $23,500 in order to exercise this contract. As you can see, this is a large sum of money, which is why not many people exercise the option. Instead, most will choose to just close the option to lock in the profit from the increase in premium amount. Options trading can be very rewarding. However, please keep the following in mind whenever you are thinking of entering a trade. Know your risk tolerance. Do your own research. Limit your trading size. Be aware of your risk versus reward in each trade. Get educated. What I presented here are just the basics. There is a lot more to option trading, such as different option strategies. I encourage you to continue learning on your own regarding option trading. Happy trading! Thank you for watching. Please like and subscribe to the channel. It really helps the channel grow. Also, please check out my other videos. Thank you and see you on the next one.